And we are live for another VC Wisdom pod with Josh Wagner. Josh has his podcast. I watch a couple. He's also been in sales and nowadays is into VCing with a couple of partners. Quite excited to have him on. He's a co-founder and partner at In Revenue Capital. Before we actually get in the weeds, this podcast brought to you by podpire.com, which is my company to start, scale, or be featured in a podcast as a guest. So podcasting, as Josh will tell you, is amazing to get insights, to get great guests like Josh himself, but also to get clients. You know, I've got lots of people reaching out to me to actually become clients. Plus all the subscribers, it's a no-brainer. Podpire.com if you want to start, scale, or get invited to a pod. Josh, I'm really happy to have you on. Can you introduce yourself? Tell us a bit more about In Revenue Capital.
Yeah, it's great to be here. Thank you for having me on. In Revenue Capital is the first ever operator immersive venture capital firm. So essentially what that means is my partners and I are all operators. We all had exits within the past 3 years, and we are taking our experience as CEOs, CROs, chief product officers into the venture world. So when we invest, we don't just invest capital, we bring operator experience alongside of it. So we really help our founders go to market. We work with early stage growth companies that have established some product market fit, but are looking to scale their go-to-market fit. So we help them with sales, marketing, and we have a heavy lean towards partnerships. So we look for either the presence of or an untapped partner ecosystem that they can sell into.
Love the angle here. Can you tell us about your background in sales? I see some VP sales role. I see enterprise account executive roles here. Tell us about that role and how you're going to bring that into your new venture here.
Yeah. So, when I graduated from college, I started my first company, and essentially I was the sales arm of that company, helping us bring in new clients. When I moved on from that business, I took on had a sales role at an e-learning company, essentially helping to identify niched vertical markets that we could sell our services into and really create niches for ourselves within that business, because e-learning was fairly saturated at the time. So we needed to find a way to differentiate. So I was building little tiny businesses, leveraging a shared service model. And then when I moved to LeadMD, that's where I met my current partner and co-founder of In Revenue Capital, Justin Gray. He was the founder of LeadMD. I came in to help run sales at the time, both as a quota carrying seller and as a sales leader. So my job was to sell to and through partners. We were really big in the Marketo ecosystem, which eventually got acquired by Adobe. And I was responsible for revenue growth within the organization. I had thousands of clients in my 10 years there. I, did over $5 million in revenue personally every single year, plus that of my team. So yeah, I have a ton of sales experience in the mid-market and the enterprise, and I'm trying to bring that to the founders that we work with.
So you're winning the most badass websites of the month in Revenue Capital. Dude, yeah, like that guy, Grifflin. I'm going to talk to that guy. Yeah, very good website. Love the branding.
Thank you.
Were you part of the whole project?
I was, yeah. So we just founded the company in January of this year. And one of the first things we had to do was, get a website going. So we had worked with Ron and his team prior at another organization. But originally we just had them put up a landing page with our manifesto, and that lived there for roughly 5 months. I think we went live in May or June, and, a lot of work put into it in terms of custom graphics, art, getting our unique spin on venture capital put in there, and really just continuing to pump out content. That's one of the ways we try to differentiate ourselves as well.
Brilliant. What type of businesses are you aiming for? What type of vertical would it be, like pre-seed, seed, series A? What are you aiming for here?
Yeah, so we focus on B2B verticalized SaaS, and we are a seed stage company. So we look at seed plus rounds. Oftentimes we are helping do a bridge round between a seed and a seed A. You could call it a seed plus, or seed 2, whatever you might want to call it. But we write $1 to $3 million checks. We look for companies that have established some product market fit that typically looks like, say, $500,000 to $1 million in ARR, but are lacking go-to-market fit. Oftentimes that seems like founder-led sales to that point. So the founder has grown up in their space. They found a problem, they turned that problem into a product. Oftentimes they're a subject matter expert or a product expert, but not a sales expert. They've just been able to go out and use their passion to sell and get traction in the marketplace. And we step in then and help them scale that go-to-market from that point forward.
How much time do you think you'll invest, and how much extra capital other than the investment will you invest there?
So we're going to have a lot of time, right? The sweat equity alongside the money that we put in. So we see our goal, again, we're a new firm, is a pretty heavy initial 6 months where we start coming in and doing workshops, even in diligence sometimes, to establish where they play in the market. What does their ideal customer profile look like? What does the partner ecosystem look like? How are we going to take down that initial batch of next round of growth? And we hope that after that 6 month swell, it starts to tail off a little bit so that we move a little bit more into advisory. However, all of our founders have our cell phones. We're working with them pretty frequently for anything from hiring to setting up S corps in the United States. Like, there's a whole host of things that we find ourselves doing.
Are you focused in US or go worldwide?
We're not worldwide. I would call it North America. So we currently have investments in the United States and Canada.
What's the thesis behind VCing? Because you could just continue doing what you're doing, the pod, the speaking, the AE roles, the VP sales roles. You want to save your time here, or why not just invest in, like basic funds and let the money grow there? Like, why do your own thing and potentially wait 10 years to have an exit? What's your thesis there?
Well, we're entrepreneurs, right? So maybe it seems like the hard way, but it's the way we know how to do it, right? We're not afraid to work and put in the effort, but we also think that we are different. And the proof is in the pudding with that. We have founders literally every day telling us that we want you to lead our round. We want you involved. What you're adding is different. You don't ask the same questions as any other VC. And for us, that gets us excited, right? Like, we know that we're onto something special and we're doing something right. If it takes 10 years, I don't think it'll take 10 years for an exit. Our focus is a 3 to 5x return in 2 to 4 years. And that could be returning capital at an A round. It could be an acquisition, but part of what we're looking for when we evaluate companies, part of that partner ecosystem, is also building into a community where you have a higher probability for acquisition, which is going to have, more than a 3 to 5x. That's when you start getting into the 10 to 20x multiples. So we're really looking to do it different. Return, the IRR, or internal rate of return, that we're looking to establish within our portfolio is almost 10x what you'd see in typical venture capital. We feel that typical VC is doing it wrong. They're basically in the movie making game. They're hoping that 100x return covers the losses for the rest of the portfolio. And frankly, it's not a founder-friendly model. It's something where it's not an investor-friendly or a founder-friendly model. So we're looking at giving our investors the opportunity to return capital every 2 years and take their returns and reinvest with us. And that should yield a IRR that is well above industry average.
And isn't that like counterfactual right there? Because VCs, they want like a 10, 100x over a 10-year period. And well, you're aiming for a 2 to 4x or 5x exit in a shorter time frame. How does one do that without having to invest massive quantities of cash? Even if you input your time, I guess you would need like experience to kind of help them in that very field. Is it like some of your GTM strategies that are coined and their systems, their SOPs basically, and you can reuse them over and over again?
Correct. We've created a go-to-market toolkit that is, what we use to enter into any business and get it off the ground. It might need to be tweaked and fiddled with for every business uniqueness, but everything that we build is for scale, and it's based on our experience as operators. To your question about being counterintuitive, time is the key element there, right? If you take that if you say, okay, I'm going to commit $1 million into a fund and expect a return in 10 years, that's different than you committing $100,000 at a time and getting returns every 2 years that you can then reinvest. Your capital starts to multiply faster, And that's how that IRR hockey sticks if you compare it to a typical venture capital growth curve.
Plus the credit that you establish at the bank, of like, hey, we've done that, we've had multiple exits. Is your filtering process better because it seems that you're striking more home runs at the bats than VCs? So like, is your filtering process of who you accept in or not, is that more detailed than a VC's?
Our aperture is incredibly narrow. So we're just by going B2B verticalized SaaS, we're narrowing the lens of possible candidates by thousands right out of the gate. As an example, I just did an exercise of filtering through companies that I would want to sit with one-on-one at a VC event in Seattle in a few weeks, right? Of the 40 companies there were like 6 that fit even those minimum criteria, right? So automatically we're filtering down to where we know we can win based on our experience. I'm not going to invest in consumer because I can't help a consumer company go to market. I don't have any experience there. I'm not going to invest in horizontal applications because I don't think I have the same ability to apply partners into that application, right? So there's a lot of different criteria that go into that. We obviously have to do some of the similar filtering that other VCs do. We have to look at the financials. We have to look at the cap table. We have to look at growth. And those are things that everybody's going to do. But where we hear from the founders that we talk to that we're different is really how we look at their buyers, how we dissect their pipeline, how we understand where they play and what they're doing to go to market today. And I just think that it stands out head and shoulders above any other venture capital firm that they talk to.
So your ideal fit, would it be like this technical founder, a super nerd without a sales counterpart?
Maybe. I don't know if they're necessarily super nerds, but I can say the founders that
I'm a
we've worked with have
nerd,
been,
but I'm also in sales.
Well, that's a unicorn, right? It's tough, but I will say that's the uniqueness of a lot of the founders we work with, right? They're very product focused, they're subject matter experts, but they're not afraid to go out there and roll up their sleeves and get those initial sales and get that traction. If we meet with a founder who doesn't get the value of sales and hasn't tried it, at least, even if they've not done the best job, they're probably not a fit for us, right? We're really looking for that self-awareness.
So the VC thing, let's call it 80% of your time spent. The rest, is it the podcast, consulting, speaking gigs?
I mean, podcasting probably only takes up a couple hours a week. I mean, we don't do a ton of it. We do the recordings and then we hand it off to our PR firm to get it out and edit it and do all that type of stuff. So it doesn't take up a ton of time. I don't do a ton of speaking. You know, when it's event season, I might get called on to go out and speak and do an event or this or that. If it makes sense and the audience makes sense, I'll definitely do it. But I would say the firm and our founders take up 80% of my time.
Right. How do you fuel those batteries? Like you see this nice home gym behind you, like you take care of yourself. Like, how's that part of your whole system to stay productive?
I'm a pretty regimented guy. I like to get up early. I like to have a little bit of time by myself. So I also have 3 kids and I'm married. So there's also that requires my attention. So I try to be super productive as early as possible, just because I start to fade as the day goes on. So getting my half hour of, coffee, get myself revved up a little bit and then hit a workout for an hour and a half, and then get the kids ready for school. And then after that, it's hit it hard for, 6, 7, 8 hours, and then be able to wind into, all right, kids are coming back. Let's spend some time with them. Let's get dinner going. Let's at least have time for everyone to meet, and then, get to bed at a decent hour. That's a bit of the rinse and repeat. It sounds a little bit boring maybe, but there's really no other way for me to keep myself going.
Well, as long as you're happy, is happiness a KPI for you? Has it been?
I don't know that it's a KPI. I'm a pretty easygoing guy for the most part. I will say that moving, if you want me to peel back the onion a little bit, moving from a high paying sales job where I was making a lot of money and a lot of cash flow into a business where you're not really having cash day over day and you're investing, right? For the long term, that has added a level of stress to my life that I'm not necessarily used to. So I've had to, get used to that. Obviously, I know what's good in the long run, but from a family standpoint, you have to change expectations, change perception, change a lot of different things when the they're used to one thing and saying, listen, it's not just rolling in like it was when I was just knocking down deals all the time. There's going to be a little bit different ebb and flow to how we make money. So it's been a little bit of a life transition, but all for the good.
Yeah, exactly. And hopefully the sales cycle are somewhat shorter, 2 to 3 years. They're not 10. And that's a very cool thesis, by the way. That I really want you to keep me in touch for that, the results of that. I'm hopeful also, since you're a sales guy, that's what you bring to the table, and you know about cutting these long sales cycle short. So love that aspect there. But yeah, sometimes you need to grow out of your own zone. I'm guessing you want to reach another level of wealth and do something different, which is perfectly normal. Question for you though, like you talked about the high salaries, 5 million a year. Am I assuming that's 500K salary at least a year?
Say it again. High salaries. What do you mean?
Yeah,
What do you mean?
your AE role, right? You told me 5 million minimum yourself on a yearly basis. 10% of that.
That's what I was selling. Yeah. Right.
So
So
that's
those are my
500K in your pockets on a yearly basis
correct.
minimum,
Yeah. Minimum. Yeah. So I had a
which
pretty
is
good run
very
of,
good.
yeah, very, very good. Right. So, you get into a rhythm, you stay. And I think that's one of the things that folks, if you're in the sales world, there's so much hopping that you see going around. People don't last much more than a year, 2 years, sometimes 3 years, and you're a long time vet after that. I was with LeadMD for 10 years, and there's some value in that sort of longevity. And from a sales standpoint, it's really becoming deeply ingrained in your ecosystem, in the market, with the buyer that you're selling to, where I call it, you can predict the future and twist the knife. So if you know your buyer so well that every time you have a call with them, based on what they tell you, you can predict their future the next 2 weeks, 2 months, 2 years out, and they are like, oh crap, he's right. And then you can start to take that and twist the knife a little bit to be like, this is what, if you don't make a change, this is what's going to happen. This is what your future looks like. That gives you immense leverage to start to grow that book of business and grow a trusted ecosystem of people that you can continually tap into. So I was super fortunate to be in a good situation. Obviously I had to produce and perform, but not every situation is perfect for everybody. But I do think that finding a good spot and taking advantage of it is critical.
All right. So it's all about stabbing and twisting the knife. No, but it's true, like the pain is the way to go, because humans, they don't want to lose their job. They don't want to not reach their goals, vs like celebrating victories. A lot of humans, let's call it 85% of us, we operate on fear, and we don't operate really on rewards. I think it's only the top CEOs and founders and possibly VCs that do operate on, rewards. And even VC is also a stressful job, especially in the classic path. You invest in 10, 100 startups, and then you see like most of them failing, right? Like that's pretty painful.
It's really hard.
Especially when you invested your own money that you could have invested in your kids' college or something. But no, I still think it's really much worthwhile. I want to finish the pod just covering a couple of investments that you did, and if you can comment on the niche and the thesis. Sure. Pit Stop, I have Statera here, and I have Rising Cloud.
Sure.
So can you tell us about these and the why?
Yeah, for sure. So Pit Stop is, as in Revenue Capital, two of the first deals we did were Pit Stop and Statera. Both of those we were follow or second chair partnering with another venture capital firm. And that was a strategic move for us coming out of the gate as we were, growing and learning the ropes. We had good relationships with both of them. Shout out to DWP Capital in Phoenix and Tech Square Ventures in Atlanta that we partnered with on those deals respectively. But each one had some similarities and then a lot of differences. Pitstop is a predictive analytics platform for large vehicle fleets. So think Amazon, right? They have a huge fleet of vehicles that go out and do deliveries and whatnot. And they are helping those companies predict when something's going to go wrong before it does, to reduce downtime, which costs them a lot of money. Every vehicle and fleet out there has a preventative maintenance plan, but it's all just, making sure that they change the oil, change the tires, rotate the tires, and, change fluids and whatnot. This is truly predictive, where they're pulling the data from their telematics platform, from their work order systems, from their fleet management systems and predicting when something's going to go wrong down to the vehicle level. So it's really cool. They're very differentiated, and that company is doing extremely well. Statera is a physician compensation platform. The founder was a physician compensation director at a hospital system. She saw how manual, tedious, error-prone, and how little visibility physicians had into how they were compensated. Physicians are actually compensated a lot like salespeople. It's all performance-based. There's a lot of variable. And you know how it is when you, as a seller, when you feel like someone's screwing with your money, you get pissed off, you don't understand, things happen, you leave, all that kind of stuff. So she created a software platform that pulls all the data from the HR systems, the EMR systems, all these different things, and streamlines how compensation is calculated, giving visibility to the physicians on the front end and reducing errors and time and automating things for the healthcare system. So it's very cool. Yeah. Rising Cloud was an angel investment that I made right before we started in Revenue Capital. Actually, we were still in the formation of the company, very much hitching your wagon to the founder at that point. The founder, Dave Wattell, is a serial entrepreneur, has had 3 or 4 exits in his career. And I just believe in him. And the technology is interesting. It's fully patented. He's going against the Goliaths in the industry, AWS and Microsoft and Google, but he has some unique technology that allows him to find some niches where he can go win and play. So that company has a new CEO coming on board. Very excited about where they're headed.
So I'm about to advise a company that's fixing the GPU shortage through software. Do you feel that there's a lot of these companies, and do you feel that it's the selling picks to miners analogy type of company? Do you think they can go in hypergrowth? Do you think there's too much competition? Because the GPU shortage problem is pretty huge, especially if there's mishaps in Taiwan. That is, what do you think about that one?
Yeah, I think it's tough. GPUs are obviously going to be in higher and higher demand as we do more AI, and it's just going to require more processing power than ever. I mean, the amount of processing power required to scale this is just getting insane, and that's something that Rising Cloud helps with. They have GPUs on demand, but I think figuring out the supply chain, how you can get more nimble with GPUs, how you can get them in the hands of it really is finding a way to support the big players, right? Because no one's going to overtake Microsoft, Amazon, and Google. Like, they just have so much power. It's how do you fit into that ecosystem, right? And how can you augment what they're doing to make it better, I think, is where you're going to differentiate. Trying to beat them out straight up is going to be really difficult.
Right. Last question. Couple months left to the year. What do you want to accomplish? And in 20 to 30 years from now, when you're on your deathbed, what legacy do you want to leave?
Yeah. So by the end of the year, I'd like to have 3 more companies in our portfolio. That would be a good win for us. As we wanted to try to get in 5 to 6 this year. If we get to 3 or 4, that would be okay. As a new firm, I think, we're learning, but yeah, that would be a big goal for this year. When I'm on my deathbed, I hope that my kids think that I was a good dad and I gave them the best life possible. Like, honestly, that's all that really matters to me, is that the kids think highly of their old man. I certainly think highly of mine. He's one of my favorite people in the world. So I would hope that some of that rubs off on my kids.
Love it, dude. Yeah, I wish pretty much the same on my side. I'm waiting for mine in less than 2 years, and apparently it changes your perspective, makes you a little less selfish. So I'm eager to see that, and yeah, my priorities will probably align. Josh, thank you so much. This podcast has been brought to you by podfire.com. If you want to start, scale, or